In this video, I'm going to discuss the tax consequences of distributions that are made to shareholders of an S corporation. Now, first of all, the amount of the distribution is going to be equal to the amount of cash being distributed plus the fair market value of any non-cash property being distributed. So, for example, if a shareholder of an S corporation is given $10,000 cash plus a piece of land that happens to have a fair market value of $25,000, the total amount of the distribution to the shareholder will be $35,000. Now the question is, how would that distribution be taxed? Is this going to be taxable income to the shareholder receiving $35,000 of property? And the answer is, it depends. Specifically, it depends on whether there's something called accumulated earnings and profits, AEP, which we will get into. First of all, let me do the more basic example where we have no AEP. Okay, so if there's no AEP, which I'll get into in a moment, then a distribution is going to be a tax-free recovery of capital and not taxed to the shareholder to the extent of the shareholder's stock basis. Okay, any amount that the shareholder is given beyond their basis, right? So if they're given a distribution of $35,000 and their basis was only $10,000, then the distribution would exceed their basis, and that excess would be treated as a gain, usually a capital gain, from the sale or exchange of property. So let's do a basic example, and then we'll get into a more complicated scenario. So let's say that Willie is a shareholder in an S corporation. Willie has a basis of $40,000 in the stock of the S corporation. Okay, so that's his basis in the S corporation stock. The S corporation then gives $30,000 cash to Willie. And then the question is, how is that cash taxed? And in this case, that cash is not going to be taxed at all, right? Willie's not going to be taxed on this distribution. It's just treated as a tax-free recovery of capital. However, his basis in the S Corp stock, it's going to go from $40,000 to $30,000. So the $30,000 cash he receives reduces his basis, but he's not going to be taxed on that. Now, if you think about it conceptually, if you're like, well, wait, he just got $30,000 cash out of that S corporation, why would a distribution from the S corporation not be taxable to the shareholder? The shareholder's getting money. But remember, the shareholder wouldn't have been taxed on any profits of the S corporation when the S corporation had those profits, whether or not they were distributed to the shareholder. Okay, so just because you have the S corporation distributing cash to a shareholder does not mean that the shareholder is going to have to pay tax on that. Okay. Now, when there's AEP, okay, so we got accumulated earnings and profits. That's what AEP stands for. Things are going to be a little bit more complicated. We're going to have to go through these ordering rules, which I'll explain step by step. First of all, what is this AEP? What are we talking about, accumulated earnings and profits? Well, but remember that when you create a corporation in the U.S., so the default status is it's a C Corp. And then you make an election at a later point in time, could be immediately, could be months later, could be years later. At some point later, if you have an S corporation, that means you made an election to have an S corporation. So remember that C corporations have something called earnings and profits that C corporations need to track, because when there's a distribution from a C corporation to the shareholder, they need to determine, is it a taxable dividend to the shareholder or not. So C corporations track E&P, earnings and profits, okay, for determining whether their distributions are taxable dividends or not. Okay, I've got other videos on that if you're interested. In any event, so this C Corp, so from the time that, so if you're a C Corp and then later you make an election to be an S Corp, you still have to track that E&P that you had from the time that you were a C Corp. Okay, so if you make the election to be an S Corp and you say, okay, from the time that we were a C Corp, did we have any earnings and profits? So basically you're going to track, if you make the election to S Corp, right, and you had previously operated as a C Corp and had E&P, you're going to track your pre-election and post-election earnings. So pre-election means prior to becoming an S Corp, back when you were a C Corp, you track that earnings and profits. So that's the accumulated earnings and profits, the AEP account. And then you're going to have some profits after you elected to become an S Corp. That's the post-election earnings. And that's what I'm talking about, this AAA account, accumulated adjustments account. So this is basically, you can think about it as the profits of after the company became an S Corp, after it elected to be an S Corp. So you've got the AEP, profits of the company before it became an S Corp, and then the AAA account, profits of the company after it became an S Corp. This is going to be very important, these ordering rules for determining whether something is taxable, a distribution is taxable to the shareholder. So let's say the company has accumulated earnings and profits from the time it was a C Corp, and now it's an S Corp, and there's a distribution to a shareholder. What do? The distribution is first going to reduce this accumulated adjustments account. So it first comes out, so any distribution first comes out of any profits that have been accumulated since the company made the election to be an S Corp. Okay, so that, and to the extent that there's this AAA account, any distribution that comes out of that, tax-free recovery of capital. Okay, so not going to be taxable to the shareholder. But once that AAA account goes to zero, then at that point, then you look to this AEP account, okay, the accumulated earnings and profit account. And to the extent that there's accumulated earnings and profits, then this will be a taxable dividend to the shareholder. And now, technically, if the shareholders agree, they can make this bypass election where they basically have they can just immediately have the distribution be set against the accumulated earnings and profit account. So that's why I'm mentioning here with this bypass election. Okay, usually you wouldn't want to do that, but you could do that. Okay, and so you can elect to just not have it go through the AAA account first, but to first have it go the AEP account. In any event, let's leave that bypass election aside. Now, once the accumulated earnings and profits account goes to zero, if we still have any distribution left, then we look to this OAA account. Okay, so this other adjustments account. That's things that like tax exempt income that would affect the shareholder's basis in the stock, but not the AAA account. Okay, so we look to that account, and then if there's still any amount left, like if there's still a distribution after we've looked at the AAA account, AEP, OAA, if there's still any amount of the distribution remaining, then that will be non-taxable to the extent of the shareholder's stock basis. So it basically just reduces the basis then. And once the basis goes to zero, if there's still any amount remaining, that excess would be treated as a gain on a sale or exchange. I know that's a lot, so hang with me. I'm going to give you an example. But actually, before I get into this example, I want to show you where this would be on the tax return. Okay, so remember that Form 1120S is the tax return for an S corporation. So Schedule M2, part of the Form 1120S, that is where you're going to see the accumulated adjustments account. So that's the AAA account here that I talked about. Okay, so we see that here. You have to track that on Schedule M2, changes in it. You see distributions here, the balance at the beginning of the year, the balance at the end of the year, and so forth. And then also we have the accumulated earnings and profits. That's from the time that the company used to be a C Corp, any EMP from that time. And then we have the other adjustments account that I mentioned. So you track all those on Schedule M2. So let's get to an example. Let's say that Willie is a shareholder in an S Corp. Okay, so now we're going to have it a little more complicated than the example before. So Willie has, let's say, a basis or stock with a basis of $40,000 in this S Corp. And to keep it a little bit simple, let's say that Willie is the sole shareholder. Okay, why am I saying that? Because actually this AAA account needs to be a proportion, is prorated if you have multiple shareholders. So let's keep it simple. Willie is 100%, owns 100% of the stock of this S Corp. His basis is $40,000 in the S Corp stock. So now the corporation has the accumulated adjustments account, $10,000, accumulated earnings and profits, $25,000, and then the other adjustments account of $5,000. And then the corporation makes a distribution, $43,000 cash to Willie. And the question is, how is that $43,000 cash going to be taxed? Is Willie going to have any taxable income here? And then what was Willie's basis in the stock going to be? It's initially $40,000 prior to the distribution, but it's going to change. So let's go through our ordering rules. First, we look to the accumulated adjustments account and we reduce that first. So the first $10,000 of this $43,000 cash distribution to Willie, that's going to reduce this accumulated adjustments account. So that's going to go to zero, right? Because it was at $10,000. So basically, first we wipe this out, that goes to zero. Now, Willie's stock basis is going to go down $10,000 as well. Okay, so we have a recovery of capital here. So tax-free recovery of capital. So the stock base is going to go from $40,000 to $30,000. Now it's going to change some more, which is just the first step. But the AAA account is now zeroed out. Willie's stock basis is at $30,000. Now, we next look, because there's still, so we just got rid of 10,000, or we just treated 10,000 in the $43,000 distribution. There's still 33,000 of the distribution left to be dealt with. So now we looked at accumulated earnings and profits account. It's got 25,000 in it. We zero that out. So now we're going to have a $25,000 taxable dividend. That's from the time that this company, in the old days when it was a C Corp, it had earnings and profits. Okay, so now we looked at that. It's $25,000 taxable dividend. So the first $10,000 of distribution, non-taxable, tax-free recovery of capital. The next $25,000 is a taxable dividend. Okay, so that's going to be taxable to Willie, the shareholder. Now, there's $5,000 in this other adjustments account. Now, we see that the $43,000 distribution in total, we've only dealt with $35,000, so we got $8,000 left. So now the other adjustments account, that goes to zero. And that's going to reduce Willie's stock basis to $25,000. So generally, when we're looking at the other adjustments account, that's generally going to be non-taxable to the shareholder. So now we've got $40,000 that we've dealt with of the $43,000 distribution, okay? But we still have $3,000 left, the remaining $3,000 left, and that's just going to reduce Willie's basis to $22,000. Now, let me go through the basis because, let me summarize here. First of all, from all this to happen, Willie's going to have a taxable dividend of $25,000, and the rest is going to be return of capital, non-taxable. But let's go back to Willie's basis. This accumulated adjustments account, when that goes down, we reduce Willie's basis to $30,000. But then when we have the reduction in the other adjustment account, that's going to reduce Willie's basis by $5,000. So Willie's basis goes from 40 to 30 to 25, and then that remaining $3,000 that is also return of capital, it's not taxable, that's going to reduce his basis to $22,000. So now he still has basis. If this distribution had been a lot larger, let's say he got 500 grand cash or something, then his basis would have went to zero, and then beyond that amount, the excess would have been treated as a gain. Finally, I want to mention two things. If the S election is terminated and the S Corp goes back to being a C Corp, then any cash distributions that occur within 1 year of the termination date will be treated as a tax-free recovery of capital and not taxable to the shareholders, provided that they don't exceed the accumulated adjustments account. The second thing I want to mention is that distributions of non-cash property are more complicated than distributions of cash. But never fear, because we will discuss distributions of non-cash property in all their glorious detail in the next video.